Imagine a world without money. It wasn't science fiction, it was reality for most of human history. Long before coins and paper bills, people had to find other ways to get what they needed. People relied on a system called barter. This system was the backbone of early economies. You had something I needed, I had something you wanted. We traded, simple. This direct exchange was straightforward but had its limitations. Early humans bartered goods and services. It was a practical solution for small communities. Food, tools and skills were all up for trade. Need a new spear? Trade some fish with the skilled toolmaker. This kind of trade fostered relationships and interdependence. Want a warm cloak for the winter? Offer your neighbour some freshly gathered berries. The system worked well when needs and wants aligned. Barter worked, but it had problems. The biggest issue was finding someone who wanted what you had and had what you wanted. What if the toolmaker didn't want fish? Or if the cloakmaker had no need for berries? What if your neighbour already had enough berries? Surpluses and shortages made bartering tricky. Finding a match for your needs and someone else's wants wasn't always easy. This inefficiency often led to frustration. The barter system needed an upgrade. People began to realise the need for a more efficient system. People needed something everyone valued. A universal medium that could simplify transactions. Something that could act as a common medium of exchange. This led to the birth of money. They needed something like money. And with that, the foundations of modern economies were laid. Enter the first forms of money. In the earliest days of human civilization, people needed a way to facilitate trade and exchange goods. In different parts of the world, people converged on similar solutions. Despite the vast distances and cultural differences, the need for a reliable medium of exchange was universal. They started using valuable commodities as a medium of exchange. These commodities had intrinsic value and were widely accepted within their communities. Cattle, for example, were a common form of early money. They were not only a source of food and labor, but also a symbol of wealth and status. They were valuable, durable and divisible, though messy to carry around. The use of cattle as money had its limitations, but it was a significant step forward. Other societies used different forms of primitive money. Each culture adapted to its environment and resources, finding unique solutions to the same problem. Shells, beads, salt and grain were all used as currency. These items were chosen for their portability, durability, and the ease with which they could be divided. These items were valued for their scarcity, usefulness, or beauty. They held a special place in the hearts and economies of ancient peoples. They made trade much smoother than bartering. The introduction of these early forms of money simplified transactions and allowed for more complex economic interactions. But the real game changer came with the advent of metal coins. This innovation marked a significant leap in the evolution of money. The first coins appeared in Lydia, modern-day Turkey, around the 7th century BC. These coins were a revolutionary development in the history of money. They were made of electrum, a naturally occurring mixture of gold and silver. This blend gave the coins intrinsic value and made them widely accepted. These early coins were revolutionary. They represented a standardized form of money that could be easily recognized and trusted. They were durable, portable, and standardized. This made them an ideal medium of exchange, facilitating trade over greater distances. They made trade easier and more efficient. The use of coins allowed for the development of more complex economies and trade networks. It was the beginning of money as we know it. The journey from cattle to precious metals laid the foundation for the sophisticated financial systems we have today. Fast forward to the 7th century AD, in a bustling China under the Tang dynasty. The streets were alive with activity, merchants trading goods and people going about their daily lives. Merchants were tired of lugging around heavy strings of copper coins. These coins were cumbersome and made long-distance trade difficult. They needed a lighter, more convenient form of currency. Enter paper money, a revolutionary idea that would change the way trade was conducted. The first versions were essentially promissory notes, simple pieces of paper that promised the bearer a certain amount of money. Merchants would deposit their coins with trusted individuals and receive paper receipts in return. These receipts were easier to carry and could be exchanged for goods and services. These receipts could then be used as currency, accepted by other merchants and traders. Paper money was a hit. It quickly gained popularity among merchants and traders for its convenience. It was lighter, easier to transport, and less prone to theft. Merchants could now travel long distances without the burden of heavy coins. It quickly spread throughout China and eventually made its way westward, carried by traders and explorers along the Silk Road. The adoption of paper money was a major milestone in the history of finance. It facilitated trade and commerce on an unprecedented scale. It paved the way for the sophisticated financial systems we have today, influencing the development of banking and currency systems around the world. With paper money came a new player in the game of finance, banks. Initially, these institutions acted as safe depositories for people's money, but they soon realized they could lend out a portion of their deposits while still having enough on hand to meet withdrawals. Thus, the concept of credit was born. Banks began lending money to individuals and businesses, charging interest on these loans. This system fueled economic growth by allowing people to borrow money for investment and consumption. The rise of banks and credit was a double-edged sword. It facilitated economic expansion, but also introduced the risks of inflation and financial instability. Managing these risks would become a central challenge for governments and financial institutions. Plastic power, the credit card revolution. The 20th century witnessed another major innovation in the world of money, the credit card. The first semblance of a credit card appeared in the late 19th century, but it was the Diners Club card, introduced in 1950, that truly popularized the concept. Credit cards offered a revolutionary way to pay. Instead of carrying cash, consumers could use their cards to make purchases on credit. This convenience fueled a surge in consumer spending. Credit cards were a game changer for money. They made transactions faster. They allowed people to spend beyond their immediate means. But they also introduced new risks, like debt and identity theft. Digital dollars, payments in the information age. The late 20th and early 21st centuries saw the rapid rise of the internet and mobile technology. These advancements ushered in a new era of money digital payments. Online banking, mobile wallets, and peer-to-peer payment apps became increasingly popular. Suddenly, sending and receiving money became as easy as tapping a few buttons on your phone. The need for physical cash seemed to be dwindling. Digital payments were faster, more convenient, and often more secure than traditional methods. They also offered new possibilities for financial inclusion, allowing people without access to traditional banking to participate in the digital economy. The cryptocurrency conundrum, a new kind of money? In 2009, a mysterious figure using the pseudonym Satoshi Nakamoto introduced the world to Bitcoin, the first cryptocurrency. Bitcoin was a digital currency that operated on a decentralized network called a blockchain. Cryptocurrencies promised to revolutionize money. They were decentralized, secure, and transparent. They offered the potential for faster, cheaper, and more accessible financial transactions. But cryptocurrencies also presented new challenges. Their value was highly volatile. They raised concerns about illicit activities. Their future role in the global financial system remained uncertain. The enduring power of money, a force for good and ill. Throughout its long and winding history, money has been a powerful force in human society. It has driven economic growth, fueled innovation, and lifted billions out of poverty. But it has also been a source of conflict, inequality, and instability. Money is a tool. It can be used for good or evil. It is a reflection of our values and priorities. How we manage and regulate money has profound implications for our collective well-being. The story of money is a story of human ingenuity, ambition, and our complex relationship with wealth. It is a story that continues to unfold before our very eyes. The future of finance. What's next for money? The future of money is uncertain, but one thing is clear. It will continue to evolve. New technologies, changing demographics, and shifting global power dynamics will all shape the future of finance. Will cryptocurrencies upend the traditional financial system? Will digital currencies issued by central banks become the norm? Will we move towards a cashless society? These are just a few of the questions that remain to be answered. One thing is certain, the journey of money is far from over. It will continue to be a fascinating and consequential journey, shaping the course of human history for generations to come.